As of early 2026, the combined broad money supply, which is M2, of the world's four largest economies, US, China, Europe, Japan, is approaching 100 trillion USD. To put that concept into perspective, the figure is nearly 8 times the sum of our global central bank foreign exchange reserves. The inflation caused by printing such vast amounts of money since the pandemic cannot be quickly absorbed or consumed in just a few years. For example, if we look at Australia's CPI over the past few years, the service sector hasn't seen a substantial decrease in prices. So how do we stop the cash in our hands from devaluing so quickly? That is what we're going to share in this episode. Many people are aware that the world has essentially been printing money non-stop, which causes the purchasing power of currency to continually decline. But why does printing money cause devaluation? Because we know that global resources are actually limited. Let me use a simple analogy. Suppose there is a total of $50 in the whole world, right? And there are only 50 apples in existence. Theoretically, the price of one apple is just $1. However, let's say the world starts printing money now, and the 50 turns into 500 in the world. Note that the massive amount of money created out of thin air cannot be quickly consumed in short time. It keeps flowing into the market and stay in the market. But the problem is that we still only have 50 apples in the world, and what's the result? Our hands devalues faster and faster. So how are we going to resist the currency devaluation? How can we use the inflation to accumulate our wealth rapidly? We know that the more cash we hold, the more we lose when currency devalues, right? However, if we can borrow more from the bank, meaning the more debt we have, but it has to be good debt, then when inflation occurs, and especially as it increases, our potential gains becomes larger. And this is the exact opposite of holding cash. Therefore, we need to think about how to borrow money from banks. And why do I say this? Let me give you a simple example. Again, if, let's say 30 years ago, we borrowed about 100,000 AUD from a bank, right? 30 years ago was around 1996. We know back then, 100,000 Australian dollars, many people couldn't even imagine that figure. But now, 30 years later, in today, 2026, when we look at that 100,000 AUD, most people would agree it's not actually a very large amount of money. It's years, but some cars cost more than 100,000 AUD, right? So for everyone, 100,000 AUD today is far less valuable than it was in 96. But by the same logic, if you go to the bank and borrow $1 million, $1 million today, it might seem like a huge amount, but 30 years from now, in 2056, the 1 million AUD might only be enough to pay tuition fees. And the point is, money then will certainly be worth very little. This is why we need to maximize our borrowing from banks right now. Furthermore, the loans we take must have low interest rates and long repayment terms. The longer, the better. If we can pay it back like over 30 years, the money we borrowed will likely be worth very little by the time the term ends. This is the best method to hedge against inflation. Inflation is caused by over-issuance of currency. So if we want to resist inflation, we must control currency. And how do we do that? It's not about cash is king. I mean, cash is important and having much cash as possible. But how do we do that? It's not about cash is king, or it's not about, you should just have as much as cash as possible. It's about how we can maximize our leverage with banks. So once you understand this principle, you need to consider again, and what kinds of assets allow us to leverage bank money most effectively, where the bank is most also willing to lend. And speaking of this, the thing banks love most is actually hard assets and good assets. And what counts as good assets? It needs to satisfy the following 4 points. First, demand and supply. You must have a demand that is consistently increasing while the supply remains limited. Second, recognition. It is recognized by both the public and the banks, which is why banks accept it as collateral. Third, growth and the cash flow. You must have stable capital appreciation while simultaneously generating stable cash flow. The fourth is resilience. You must have the ability to resist the risks. So let's think, what assets fits those four criteria? Many of you might immediately think, isn't that real estate? Because resources for housing are limited, yet demanding is increasing due to population growth and the people looking to invest. On the other hand, real estate is recognized by banks and the public, and it can be mortgaged. Thirdly, houses tend to have stable appreciation and provide a steady stream of rental income. Fourth, real estate is risk averse. Even during the pandemic a few years ago, when stocks going down and the business struggled, real estate remained very stable, and many suburbs they're actually going up. Therefore, housing fits the hard assets, good asset factors, because it fits all these four factors. Banks are willing to lend to us at low interest rates and for long terms. Think about it. What else is easier to get a loan for comparing to the real estate? Where else can you get a loan to value ratio as high as 80% without mortgage insurance, with low interest rates and the long terms up to 30 years? Think about whether there is anything else on the market that achieves this fancy effect. No, right? Because this is the effect we need. Low interest rates and the long duration. This is how we can earn wealth during a process of inflation. So real estate isn't the only thing that resists inflation, but it is the one of the most effective products, or at least one of them. Currently, however, it seems there are no other assets that allow us to leverage bank money as easy as real estate. So learning on from here about leveraging banks, if we want to maximize our loans when we buy property, it's not about what we like, it's about knowing what the bank likes, right? The type of the property the bank likes determines its future trend. Because to fight inflation, you need to borrow from the bank. To borrow from the bank, you must choose what bank likes, right? I trust everyone can follow this logic. So what kind of property do banks like? First, high rent. You can pay off the bank interests, so the bank views your assets as risk-free. Second, low vacancy rates. This means your rental income won't be interrupted. Third, tax benefits. It has to have the good tax deductibility via negative gearing and depreciation, which brings excellent cash flow to the next level. And the bank assess our loans by looking at our cash flow and our ability to repay. So if your house is relatively new, allowing for tax depreciation, isn't easily vacant and has a good rent, it is easier to get a loan because the bank sees it's risk-free and it increases your cash flow. So when we buy a house, never just buy what you personally like. You really need to think about does the bank like it, and will this go up in value? We need to have the long-term vision. We need to position ourselves early and know how to maximize leverage with the bank. If you do this, as more people realize the threat of inflation later, more people they actually will want to borrow from the banks, and more people they will choose the same product that banks lend against easily. At that point, your product actually will be appreciated faster. And we have been observing this in the last couple of years. I hope you understand this sharing. Just as Robert Kiyosaki told us long ago, when we choose an asset, don't care too much about the short-term appreciation. Even the price dips briefly, as long as it's within our range of affordability and it brings good cash flow that improves our life, meaning the cash flow covers all the expense and leave extra money in our pocket to improve our quality of life, then that item will definitely appreciate in the long run, because people need such products. It is a good asset. And on the other hand, if many people buy things that they have decent capital growth but require them to constantly pump money in because the rent does not cover the expenses, despite the visible appreciation on paper, in Robert Kiyosaki's eyes, that in my eyes as well, that is a liability, because it affects your quality of life. It requires you to take money out of your pocket to feed it, right? If one day you can't afford to keep the house, you will have to sell it in panic. And when you panic sell, you might waste all the period. When you panic sell, you will waste that period of appreciation, and you have suffered a lower quality of life in the meantime. Therefore, asset appreciation is actually a process that happens alongside our happiness and income growth. I hope today's sharing is helpful to you. First, understand how to effectively resist inflation, maximize borrowing from banks, what allows the maximum borrowing, good assets. And what good assets do banks like? Those with good cash flow and a stable income. Once you understand this, you can seize the opportunity to become wealthier during this upcoming period of constant inflation, rather than letting your time devalue. So if you found this episode useful, please like and subscribe our channel. I will see you next time.